The financial system is approaching panic mode. The yield curve inversions and the countless other indicators can be ignored, but they will remain apparent to those who are awake. The central bankers around the world are looking at their options at this point. The ECB started a new round of money printing. Some other central banks have brought interest rates down. And now the Fed is beginning to suggest a rate cut might be on the table. Let's see. You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening with the yield curve. We're going to talk about the bond market. We're going to look at the Federal Reserve. We're going to talk about interest rates. And then I need to discuss Deutsche Bank. I have a jam-packed episode for you today. Let's begin. Market uncertainty has sent investors fleeing for safety, including low-risk debt, to seek protection from market volatility as trade conflicts between the US and its trading partners have deepened. This has been the case actually if you look back since about September, October of 2018 as the money started fleeing out of equities. We saw that with the EPFR data. I disclosed that to you on several videos. You can see that information for yourself always, but I just wanted to continue on here. The yields on the US 2-year notes are on track for their biggest 2-day fall since 2008. The 10-year is going to the lowest level since September of 2017. German government bond yields fell to an all-time low as well. And now investors are betting that the Federal Reserve is going to cut interest rates. This is always the solution. Anytime you have a problem, give out more easy money. The only problem is that this time around, the Federal Reserve and other central banks didn't get back to where they were previously, and so there is less room to work with. They've acknowledged this previously. They've talked about it many times before. Everybody from the bankers to the central bankers and the analysts have been mentioning this. They were hoping that they can get those interest rates higher. I even thought that they would get interest rates higher to at least 3%. Unfortunately, the Federal Reserve couldn't even do that because the economy is looking so weak. They couldn't even get it past 2.5. My goodness, historically, that is extremely low. 10-year yield continues collapse on slowing growth fears, falls as low as 2.07. So I just wanted to show you this. Now, obviously, in the last little while, this has basically been free falling. But take a look. Since October, it has been coming down quite significantly. So I just wanted to give you an idea of what we're looking at right here. This is some other ones just showing you the 10-year Treasury yield as well as the Treasury yield curve inversion. The 10 and the 3-year crossing over, and you can see right there how it looks. This is not the only one that inverted. Of course, several have. This one happens to be rather important, but I think of all of them as basically the same. They are just signaling something that happened previously and the time before and the time before that. And every time we see this, a recession is imminent. Now, what's also interesting is that when the Federal Reserve comes in to cut interest rates, typically the actual recession is not far off. So when you get the yield curve inversions, it may be as much as a year or perhaps even more before a recession hits. But when the Federal Reserve tends to cut interest rates, it is only months away. Now that's history. That doesn't necessarily predict the future, but this is what has happened. I believe that everybody should be hedging their bets. They should be practicing good standards with a diversified portfolio, and they should not be taking risk right now. This is not the time to do so. You should definitely spread out in what you think is safe. I'm not here to tell you what to invest in, but definitely watch out for these indicators. Sudden drop. Yield on 10-year U.S. government debt posts the biggest weekly decline since 2014. Just showing you how significant this really is. And it's been happening seemingly, if you look in the news, all throughout 2018, they were talking about how wonderful the stock market was going to be. It never really turned out that way. In fact, all the markets came down. 93% of assets were in the red. Then in 2019, we saw this resurgence after obviously quarter 4 of 2018 looked so terrible. 2019 was amazing. All these markets are up 20%, 30%. Things are looking fantastic. We'll just ignore all of these different factors and then look at where we're at today. There's really something that remains to be just constant and never-ending repeated patterns that people ignore. Fed funds futures contracts extended their rally Monday and are now indicating 68 basis points of interest rate cuts this year by the U.S. Central Bank. This tells us what they are predicting will occur. We don't really know until the Federal Reserve meets up, until they actually vote and make it happen. They're going to let the people know after it happens. So this information here doesn't necessarily mean anything, but I just think that it's important to cover to let you know what those in the industry believe is going to occur. We've been surprised before, both on the up and the down. This just gives us an idea of where the investor mentality is at today. Busy betting on Fed cuts. Amount of easing priced in has surged over the past 2 days. Just showing you this here, the blue line being the Fed funds rate. And you're looking at the difference in between this and the implied yield on the January 2020 Fed funds future, just to give you an idea of how things have really changed just over the past few months. The trade issues, obviously, the global economy is slowing down. We have seen interest rates really putting pressure on all of these other systems because they rely so heavily on debt that unfortunately the market needs easier and easier money. They can't go up to where it was before. In the previous cycle, it wasn't even at 6% on the Fed funds rate before they had to bring it back down. Now we couldn't even get past 2.5%, and this shows you the absolute weakness that is apparent. Policymakers suggest the U.S. trade issues may test the Fed's patience. Federal Reserve policymaker on Monday, by the way, this is Bullard, you might know him. He's the St. Louis Fed president. He said that a rate cut may be needed, quote, soon, the strongest signal yet that the central bank may change course as trade tensions threaten the U.S. economy. This happens to be one individual who's been calling for a drop in interest rates and QE4 since the day QE3 ended. That's how ridiculous this individual is. Constantly, never-ending stimulus is what this person wants. Why? Because he knows it's going to make them look fantastic when the devaluation of the dollar brings things up like assets, for example, up higher and higher, and he's gonna be, thinking that he's got his job secure and so on. That's what he's worried about. He's not worried about the inflation that's caused by this. He's not worried about ruining the dollar. He's worried about the short-term noise. Now, this is one individual, okay? Now, he is actually able to vote, so he's probably going to be voting for a rate cut, though in this article, when they interviewed him, they basically just said that he's not necessarily going to say that he's going to vote to do so, but he's going to wait for everyone else to see what they say, and then he'll make his vote. I have an idea. I think I know what he's going to vote on. If the incoming data were to show a persistent shortfall in inflation below our 2% objective, or were it to indicate that global economic and financial developments present a material downside risk to our baseline outlook, officials would take that into account in assessing whether the interest rate should continue to remain unchanged. That's according to the Fed's vice chairman. So this tells you if there are some conditions that are changing, maybe that's the stock market declining, maybe that's some problems and increased trade tensions that are going on, obviously they're going to go out there and they're going to have to reduce interest rates. Now that to me is a telltale sign. We're seeing two high-level people in the Federal Reserve acknowledging what's happening today, and so it is only a matter of time before they do this. And then further down here, it's pretty funny. He says, although the economy was in a good place, if we saw a downside risk to the outlook, then that would be a factor that could call for more accommodative policy. Interesting, so interesting. Now, we could probably assume that they're not talking about QE4, rather discussing the actual drop in interest rates, because at this time, they have said that this year they're going to stop with their tapering, which was extremely short on the balance sheet, and so they're probably going to go for this. As a matter of fact, we'll actually have to see that at the next meeting, see what they talk about, see what they do. And then the last one on this subject, JP Morgan has decided to accept the Treasury market's foreboding signals about growth. The bank is cutting its year-end predictions for yields and interest rates and predicts that the Federal Reserve will cut rates in the second half of this year. So they break it down further in here out of Barron's, but I just wanted to basically touch on that point that all of these big institutions out there, they are looking forward to this because it actually gives them an opportunity to stay afloat for longer. If you look at it on a different level with these financial establishments, they actually like higher interest rates because when they're loaning out to customers, they can make more profit. But it depends on what that business does exactly, not necessarily consumer loans, but all of the different transactions that they go through, having low interest rates may often benefit them. If you see value in the information presented in this video, please give me a thumbs up. It is very easy to do so. Just click that one button and you're supporting me. If you want the financial education that you weren't taught in school, that was left out of the school system intentionally to keep you knowing the truth, you got to check out these two videos. Click on the link in the description. If you want the audiobook, that's available at themoneygps.com. If you want to see a full breakdown of what's happening with Deutsche Bank, this is part 2 of this video. Click on it and I will see you there.